Good afternoon, everyone. Welcome to our foreign multi-residential panel. We just had a fantastic panel looking at the Canadian universe, and now we're going to broaden our horizons. With us today is Dan Oberste, CEO of BSR REIT, Scott Shoeman, COO of the newly public Dream Residential REIT, Philip Burns, CEO of European Residential REIT, and Sandy Poklar, COO of Firm Capital Apartment REIT. So jumping right into it, Philip, you've probably been the longest on the public side looking at residential outside of Canada. How would you characterize the feedback you get from Canadian investors being 100% exposed outside of Canada? What kind of feedback are you getting from local investors?
Yeah, so I mean, as you say, we're 100% outside. We have about 7,000 units in the Netherlands, or about 2 billion euros. The Canadian investors, again, if we, to the extent we can, ignore the current, including this week's volatility, they very much appreciated our exposure outside of Europe, and they utilize that actually to get non-Canadian exposure. It also gives them exposure to the euro, where our operational currency, functional currency is all in the euro. So the Canadian investors have appreciated that. In terms of our local investors, frankly speaking, almost all of our investors are indeed Canadian or North American. So people very much like that it's a pure play. People very much like that it gets them exposure to the euro.
Perfect. And Dan, running a US focused REIT, which is maybe a little bit less of a learning curve or more understanding to Canadian domiciled investors, do you see the same thing?
Something similar. I think at times, on account of the physical disconnect and the kind of the different business strategies between US and Canadian multifamily, I think the feedback involves more into a political and economic education with the investor. It's conducted by the REIT and our teams. I'd say in multifamily and in particular, the contrast between Canada and the US seems somewhat fairly extreme. For example, in the United States, the developers develop a significant amount of new supply in popular markets each year. Land tends to be readily available, and so the conversation can move towards, I think, value add rehab, which is very familiar to the Canadian investor and has been very successful in the past few years, but also into the impact of new deliveries, it can be a bit more of a foreign topic to the Canadian investor. I think the other thing is Scott's team and I are both attempting to communicate to our team or to our investor cohort in Canada is the migratory shift to the Sun Belt that we're seeing and that we have seen for some time. It's these numbers and these inbound move-ins that I would say in these non-gateway markets. In Scott's case, Tulsa, where we've owned and have been very successful in many of Dream's properties, as well as the BSR properties in the markets in Austin, Dallas, and Houston. These markets continue to see a rush for affordability-driven reasons down south, where it's a bit warmer, a bit less congested, and you can live in your bubble for, I'll call it, half the rent check that you could otherwise live in Boston and Philadelphia and New York. It's fun at times to enter into a discussion with a Canadian investor, but it does evolve into more of an education of the different business lines. I think the last thing I'd say is the US doesn't see a whole lot of affordability, direct or indirect rent control measures. And the average turnover ratio in the United States tends to be about 50 to 60%. And to contrast that, in Canada, you have the in-demand markets have really a significant, I would say, downward pressure on rent control. And that can thin up operating margins of an otherwise very healthy, very skilled Canadian multifamily owner. And the US and in the Sun Belt in particular, it's almost a devoid conversation. So that enables us to increase rents on new up to CPI increases, and increase rents on renewals up to the same amount as news. And those conversations are fun, but it does certainly evolve into an education. You can turn into a professor real quick, and sometimes that can be unhealthy.
Scott, having just gone through a big roadshow, same sort of things?
Absolutely. I think Dan, provided a great intro there. A couple things that we would just typically point out as some variations between Canada and the US and multifamily. First off is just the size. In the US, there are 40 markets of 2 million people or greater. And so the volume of multi-residential is substantial. And there's a lot of room for a lot of us to play in the same space. The second point, and Dan highlighted this, is just the difference in or lack thereof of rent control. Rent control is a growing thing in the US, but it's really in the gateway or the coastal markets where we see that predominantly playing itself out. In our core markets, we see no rent control. And in fact, that goes into how we select our markets up front. And the second thing is, a lot of the utilities at most communities in the US are borne by the residents. And so it's, you'll see when you look at NOI or the OpEx, the utility percentage is quite a bit different. So we spend a little bit of time just communicating with our investors in Canada, a little bit of the difference there. But one thing, Dan mentioned the migratory nature. It's population migration. It's also business migration. I mean, just this morning, Caterpillar announced that they were moving their international headquarters from Deerfield, Illinois to Irving, Texas. Now they already have a really nice sizable office in Irving, but they're relocating their corporate global headquarters. And that's been an indicative trait that we've seen over really the past 5 years, heavily in North Texas, but we've really experienced that in all three of our core markets. People and businesses moving from Illinois across the border into Ohio, Californians moving to Texas, Texans moving to Oklahoma. We've seen that kind of migration in businesses and in demographics. And it's an exciting thing. They're going to the Sun Belt. As Dan mentioned, they're going to places where it's nice to live, where there's good lifestyle amenities, where they're not downtown in a high rise. They're going to a less dense environment, and they're going to an environment that is pro-business and less regulated. And we're seeing that in our core markets, and really indicative of that in the news is of course North Texas. So it's a very exciting place for us to be. In many ways, it's disconnected from the bad news of the headlines right now. The rent growth has been strong. Our resident renewal rate has been exceptionally strong, and it really the boots on the ground operations are disconnected from sort of the pricing and the volatility in the larger market right now.
That's fantastic kind of background on the rationale of Dream Residential. And I guess, can you just talk to a little bit, about what your thesis and MO is in terms of the type of assets, value add versus, growth and that sort of thing?
Right. Well, we sure love growth. We love population growth. We love job growth, and we love income growth. And those growth metrics lead us into the markets where we are and the markets where we're going to move into in the future. But our average vintage community right now is 1986. It is what we like to call the middle of the middle. During times that are lean or tough, we see people from luxury, high-end Class A move into our middle of the middle type of essential housing. And during more flourishing times, like we've seen through Q3 and Q4 of last year, well into 2022 right now, we see people in more entry-level apartments moving up into our communities. So we really position ourselves in the middle of the middle. Some people would say the missing middle of essential housing across our country, because you simply can't replace it due to construction costs, due to land, and all of those things. So, and I think many of us are in that sort of category. It's a big space. We have that 1986 average vintage. We love to buy things and create value by improving management, by bringing professional management people, professional management processes, and we love to sustain and take care of those assets. We have wonderful assets. We're constantly improving them. And the last part of it you mentioned, Rob, was our value creation or our value add. We have in-house renovation teams that are designed to operate in lean times and in flourishing times. And as Dan mentioned, that's been a strong space for the past few years. We feel very comfortable in this space over the past 9 months or over the future 9 months, whatever they hold. So we're very excited about that opportunity, and we're very focused right now in today's volatility. It gives us the opportunity to focus on our day-to-day business.
Fantastic. And then Dan, kind of certainly not on the flip side, but on an overlapping Venn diagram to a bit. You've been, drastically high grading the portfolio since the IPO. And can you talk about that move and its rationale as you, continue to layer on some, really fantastic assets there too?
Yeah, sure. Rob, have you ever been to a chili cookout? I know I've been to, from the looks of it, you know that I've been to a lot of chili cookouts. So everybody's got a different type of chili, different recipe that they use to make their chili. And real estate investors are no different. What we saw in 2017 and 18 was an opportunity to rotate out of markets that we had owned at the time, notably Shreveport and Longview, Texas, Baton Rouge, Shreveport, Louisiana, Baton Rouge, Louisiana, Longview, a bit in Little Rock, Arkansas. So some smaller markets, and rotate that capital almost at cash flow parity into just faster moving streams. Specifically at that time, the opportunity for us was in new development. We saw that value add projects in 16 and 17, we saw a run up in those prices in those markets. We're buying melting ice cubes from a physical depreciation standpoint. So we just thought at the time, a trade of a smaller market into a newer market or a larger market and a faster growing stream of revenue growth from an older product to a newer product, it was the right recipe to win the chili cook-off in that time period based on what we were seeing. It's not always the right investment strategy. I think you look at the opportunities in front of you and you make the decision to allocate capital as best as you know how. And that worked out for us, somewhat rebuilding the aircraft carrier on the water, so to speak, after we went public. That played well. And I think that I'll say to a certain extent that continues to be our platform. And part of that is we think right now we've got, let's call it the youngest REIT outside of preferred apartments. It's about to be taken out in the North or in the United States and Canada from a multifamily standpoint. And we like that identity, and we think we can run those properties well. We think our shareholders can earn the highest total unit holder return at BSR by buying that product. That's not to say that other products might be more valuable or might create more of a return. It's just for our shareholders. That's what we know how to do well. And we're going to keep doing what we know how to do well.
Perfect. And Philip, I'll get to you in just a second, but before we cross the pond, I just want to, talk to Sandy. And, BSR, Sky, Dream have been, largely, and I think will continue to be largely Sunbelt focused, and certainly Firm Capital Apartment has a strong presence in the Sunbelt, and that will continue. But you are unique in having that kind of New Jersey, Maryland, New York City aspect as well. And so can you, talk a little bit to that, what the scenarios are for 22 and 23, and where you're looking, and is it, continued point south, or is it, being acquisitive where the best deal is regardless of location?
So right now, on a macroeconomic basis, what we're seeing obviously is the rise of interest rates right now, particularly within the 5-year bond, but not necessarily a move in cap rates right now. So if anything, we're looking at negative cash flows across the board on any new acquisitions. So that being said, where we are seeing some mean reversion in cap rates are in fact in the Northeast, as opposed to the Sun Belt right now. So the opportunities that we're seeing right now are particularly in the Northeast. And furthermore, what we're seeing also is not necessarily playing in the equity. I mean, our entity is unique in that we're able to play both equity and debt investments. So where we're seeing a lot of opportunities is becoming a piece of a capital structure and somebody else investing in the equity, and then we becoming a preferred lender in that we're subordinated to the first mortgage, either from Fannie or Freddie, but a senior to the equity. And we're able to get an outsized return on those investments as opposed to just buying real estate right now. So our view is over the next year to 2 years, we're probably on the acquisition side in terms of direct investing going to be a little bit of a wait and see until we see at least the reversion of cap rates to at least exceed that of the 5 and 10-year bonds that plus spreads before we go actively hard into investing. But we're already starting to see that well before this rise in interest rates in the Northeast, particularly in the New York tri-state area. And to give us some context, about a year prior to the pandemic, cap rates in the New York area were about at 3 to 3.5% on new acquisitions. Today, we're looking at 5 to 5.5, which is almost mirroring the 5-year bond. But that said, our preferred investments that we're yielding, as we've disclosed, are yielding well north of 8 to 9%. So we'll probably be preferred investors for the most part for anyone looking to acquire. And then being more of a wait and see as opposed to just going direct investing into new equity investments until at least we see a reversion of cap rates that mirror off the 5 and 10-year bond pricing.
Perfect. As a counterpoint to that, Phil, can you talk to the Netherlands and what your views are in terms of external growth opportunities, financing, going in spreads? Have your criteria changed this year, or is it going to change in the future? Oh, you're on mute.
Thanks, Rob. I definitely will hit that. Before I do, I think it's just important maybe to flush out a couple of the differentiators, listening to my colleagues and co-panelists. One thing to note about the Netherlands is people were talking about the absence of regulation in their market and whether that's a positive or the negative. The Netherlands is a very regulated market. But I think one of our key strengths, again, we work with REIT, who's our external property manager, and we have 50 guys on the ground in the Netherlands. We demonstrate consistently that even in a regulated market, we can generate top-line rental growth, whether it be on renewals because they're generally CPI plus something, or on turnover. We're getting today market turnover uplifts of above 20%. So even in a very regulated market, you can drive top-line growth. I think that's one differentiator that we work very hard to explain to Canadian and North American investors, that regulation isn't always bad. It's a very dynamic regulatory market right now, so we always have our eye on it, but you can succeed within it. And then the other thing I'll point out in the Netherlands is, listening to the colleagues talk about, submarkets, et cetera, which of course is the case in the US. In the Netherlands, it's almost one market. It's the most densely populated country in Europe and one of the most densely populated countries globally, and a third of its land mass is under sea level. So there is just an absolute acute shortage of supply. Planning is archaic. Plus, as everybody else has, you have runaway construction costs. So it's very difficult to bring new product to market. So we have this embedded asset base that is just getting more valuable over time. And you've seen that as our valuations have gone up. In terms of the world that we operate in today, inflation, et cetera, on the inflation side, we're within our own halls, we're okay with inflation because we are largely inflation insulated. All of our tenants pay their own utility costs directly. We don't have service charge recoveries or any delay in cash. So we have no exposure to utilities, given energy being the biggest inflator. And also we have no direct employees. So we have absolutely no wage cost inflation either. So, almost every item on our P&L, except for some all overhead items, insurance and things of that nature, are completely inflation insulated. So that's going to protect our NOI for our investors, which is good. You definitely are seeing it come through on financing. There's no doubt about it. In the past 12 months, we're borrowing generally floating and then swapping into fixed, usually on the 5 to 7 year point on the curve. Those costs have more than doubled, but we're coming from such a low base. Our all-in cost right now, non-amortizing debt, would be about 3%. So we're still in a positive leverage environment. You need to be, select in what you're buying. You need to be comfortable with your top line growth. Again, we do a lot of value add investing in suite to drive rental growth, but we still can buy today at positive yield spreads. But I think one of our colleagues said in the chat before, we're probably going to see further interest rate rises. So we have to remain cognizant of that. But we bought over 90 million euros worth of assets so far this year. There's product available. Cap rates are not moving yet because it's such an in-demand product, as performance has just been extraordinarily strong even throughout COVID. So we're cautiously optimistic this year. We think our P&L and NOI is very protected from inflation. On the acquisition side, we will be cautious because we have to think about more than just the spread that we lock in on day one, but what are the future rates going to look like? So I think it's make certain we do our blocking and tackling internally and, cautiously look for external growth.
Perfect. And that's something that the last panel talked a lot about was, the fact the Canadian market is so tightly controlled. Netherlands, obviously, very similar to that. Obviously anything in Texas or a lot of the southern states don't have yet rent control, and maybe that's something it seems like it's slowly bleeding across the world. But Sandy, New Jersey, Maryland, New York City, is it the way to get around rent control, doing what you do and buying into pref returns or into debt? But on the equity side, is it, make you cautious, or is it something you can work around?
No, it's something we can work around. I mean, one of the lessons we learned during the pandemic was that our rent-controlled apartment units in our portfolio, which represents about 40% of our portfolio across the board in the tri-state area, did perform very well. And it's because it's at a lower price point. People have nowhere to go, for lack of a better word, beyond that price point, other than being at a homeless shelter, for lack of a better word. And we're paying the rent. So, we view that the mix of, one of the lessons that came out of the pandemic was the mix of having free market rents combined with rent stabilized or rent controlled units provides a good income base, that we can leverage and generate returns from, upsize returns, particularly on the free markets as they turn over, which usually turns over about 20 to 30% a year. So we're not so much cautious in that regards of being owners in that market in a rent controlled environment, provided we're paying, like the old adage is, being paid for the risk. And right now, paying a 5.5 to maybe even a 6% cap rate on those assets is actually a decent return, if you will, in the right submarket in those areas. So, we are optimistic about those markets from the perspective of a reversion of cap rates given the rise in bond yields. And we're going to be wait and see to look at assets in those markets. But in the meantime, happy to help finance somebody else acquire and hold an asset in the interim and generate a great yield as they work on their value add initiatives with our capital and then pay us back in time.
Wonderful. Dad, rent control probably doesn't, not a huge focus on what markets you look at, and you have talked about recycling assets and moving into things. But are there any markets you continue to like to shrink in or exit, and markets that you're looking to either add density or be brand new to the REIT?
I think we want to continue investing in Texas for the time being. So as far as new markets are concerned, I don't see us expanding much. Rob, we've talked in the past, I think our theory of BSR is you're good at what you do a lot of. And we've been investing in Texas for quite some time. We feel like we're fairly skilled at identifying the right developers and the right partners to work with in our markets. And so long as they continue to exhibit these robust fundamentals, we'll continue to deploy our capital there. As far as shrinking markets is concerned, we have two non-core markets, we'll call them non-core, is Oklahoma City and Little Rock. And those two markets make up about 5% of our NOI, give or take. The properties within those markets are well capitalized. In half the cases, they're relatively brand new. So we don't see a lot of unforeseen CapEx costs to those assets in the near term. I do think if we see cap rate compression and the ability to rotate accretively, yes, certainly. But I think as a real estate investor, that's constantly what you're doing, is you're looking for value arbitrage between and among markets. And I think it works well to have multiple markets in play so that you get a pretty good idea of how to rotate net operating income and cash flow from one market to another. In the short term, I don't see us rotating much, if any, of our assets at this time. Long term, if it makes sense and if we can do it accretively, we're happy to do it.
Wonderful. And Scott, obviously you have a brand new portfolio, but when you talk to what regions you're looking to and why, I think somewhat uniquely you have a large footprint, not necessarily on the multi-res side, but just in terms of depth of knowledge going up the center of the country in Colorado and up through the Midwest. Is that something you'd be looking at, or going farther west?
Great. Well, I think yes is the answer in the long term. I think right now where we are is we're looking at all of what's happening and we're saying the future is an utterly unfamiliar territory. And we're comfortable with that because we are we operate, we're fully vertically integrated. And so we're very comfortable in the core markets where we are right now. We're very comfortable and we like the assets that we have right now. And so we're positioned to focus on current operations. Right now in today's world, that's mission critical. You got to be a great operator right now. And that's our focus day to day, whether it's property management, whether it's maintenance and sustainment. We've owned most of our properties for just about 5 years. We know exactly what it costs from a CapEx basis to invest in those, both now and in the future. And we're very excited about our existing assets and what we're going to be able to do in terms of creation of value going forward. On new markets, we're obviously constantly in the market, looking at what's going on. We do see ourselves moving into additional markets. We would, on our road show, we highlighted the Carolinas and the Mountain West. We've demonstrated our ability to launch into new markets to achieve scale and to achieve those associated economies of scale. And we'll duplicate and reproduce ourselves in that way at the right time. But for right now, I think we're very confident and comfortable in focusing on our operations and taking a pause right now and watching some of these things play out. But make no mistake, I know as Stephen King highlighted one time, amateurs want to sit and wait for good news, and the rest of us get up and go to work. And that's what everyone here is doing on this panel and our companies is we're highly focused on managing our assets and creating value. And we're very excited about that movement right now, whether it's the current rental growth or the tremendous value add growth that we're seeing.
Perfect. And, one of the things that, again, looking kind of cross panel into the last panel is, a huge amount of discussion around new supply. And, is it an issue? I know, land is much more accessible in a lot of the markets, especially in the US. Whereas Philip, you had a great illustration of the fact that it's not in Netherlands. So Philip, is there a new supply? I know a lot of things are built as condos and are able to kind of float back and forth as rentals. Is that something that you come up against as an issue or as a boon?
I mean, the delivery of new supply is so far below what the annual increase of demand for incremental households is. So in the Netherlands, you have some organic population growth, but what you have even more of, all the dynamics that the Western, demographics have, people living longer, getting married later, more divorces. We have all of that. Plus we have organic population growth, but it's a very open country in terms of immigration. Lots of multinationals are in the Netherlands. Just a general place for people to come to work and come to study. So, annually we run at a constant deficit of required new housing versus supply. And I don't see that changing. The government, again, it's been a regulated market for over 50 years. It's always quite dynamic and tweaking, et cetera, here and there. The government is worried about, the level of rental growth, but the rental growth is far below the house price growth. So, it remains very attractive in terms of affordability of living, particularly when interest rates are going up. But the government cannot or doesn't do anything particularly effective at stimulating new supply. The biggest problem in the Netherlands is the lack of new supply. So I don't worry about that cannibalizing our market our product. And quite frankly, that's why we're so optimistic about the Netherlands, particularly over the long term, because we have a very valuable resource that they're not replenishing or supplementing at a fast enough pace. We continue to have a lot of flexibility to drive rental growth, even in a regulated environment.
Perfect. And, Dan, you actually are, adding to the supply and doing that sort of thing, whether it's intensification, new build. Can you talk about some of the markets there and how, Dallas is something there is a lot of new supply coming on, but it's all at the high end, but just how it affects your portfolio and what you're looking to do with that.
Yeah, and if I could be so bold, I'd probably say that Scott, Phil, and Sandy are likely seeing some of these same issues. So when we look at 22 and 23, and we're looking at our projections for revenue growth, and I mean, it's not that hard. We're counting the number of people that are moving in, the household formations against the actual households that are being delivered. And if there's a supply and demand mismatch, the result is higher occupancy and higher rates. It's just a fundamental supply and demand issue. So I think what we're looking at right now is the supply of new deliveries and the economics involved in that. So, and if we're in the throes of COVID, there are not a lot of people working. There's a lot, the economies are shut down, and everyone, including roofers and plumbers, are staying at home. So you're not seeing a lot of new deliveries take place during that time period. Now, coming out of post-COVID, we've seen I'll say a supply imbalance with the availability of things like refrigerators and paint and flooring and the things that we hear that are becoming scarce. And what that's doing to the developers, it's stretching out the delivery process. I think what's unique to multifamily relative to other popular classes is if Phil's got a good deal, it's going to take 15 months to 2 years to compete with his property in that location. And the same thing with Sandy and the same thing with Scott, right? I would expect. So what we're seeing now is your developers coming into 22, we're faced with a shortage on the 10,000 different materials that are required to build an apartment or a competitor and to fill a supply void, a delivery void. That was stretching out and in some cases pausing their deliveries. Now, what's happened on top of that in the past 3 or 4 months in particular is kind of a lethal combination of interest rate increases and credit spread increases. So new starts are now taking longer to deliver, and the soft cost to finance that construction has gone up precipitously and almost doubled. So a developer who's putting their name on a guaranteed piece of debt I would say at a very high leverage point is going to be extremely methodical and I would say less aggressive in starting new projects. There's good and bad to that. As the incumbent landlord in those markets and in other markets, it bodes well for us as we look into 22, well into 23, to continue to exhibit outsized revenue growth on the NOI margin, on the leverage margin for our shareholders. But I also think that this kind of environment creates an exceedingly disciplined developer. So if they are getting projects off the ground, they're most certainly going to cost more money. That land is going to cost more money. The products that they need to build the property are scarcer, and their delivery timeline is stretched out further, creating risk for that developer. So those developments that are taking place better be doing, that developer is more concerned and disciplined about those projects than maybe we've seen in the last 5 or 10 years. That for us results, and Sandy, I don't want to speak for you, but probably for Sandy's business, results in deal flow coming your way that looks more like financing of a development, but the actual product is superior, and the submarket location is superior than the glut of projects that I personally saw in the last 10 years. So what we're seeing now, better submarkets, better properties, definite base hit on new developments, but the timeline to deliver it is going to take much longer. As a result, in some of these Sunbelt markets, but really in many of the markets around the United States, we expect elevated occupancies and organic rate increases well into the end of 2023. And if I misspoke for anybody on the panel, please let me know. I have a tendency to do that from time to time.
Okay, Scott, kind of going on to that, when you get that new type of development, it's getting more expensive, it's getting more difficult to do, land's getting more expensive, that invariably means that to make the economics work, it's going to a higher quality asset. Can you speak to how, what that does in terms of the more value add aspect that the Dream is doing, and then just, what the costs, not cost overrun, but how that cost ratcheting on, the construction side, the appliance side, labor side, everything else, how that will kind of affect you or what you're expecting there.
That's a loaded question, Rob. That's a great one. So I think I would just start by saying that the overarching supply challenges across the U.S. are what I would believe, and some people characterize as more systemic. Demand is more cyclical, but the supply challenges are systemic. The entitlement complexity and delays, the construction costs, the labor challenges, both in cost and in lack thereof, have added to the development complexity, where it is streamlining the participants in that cycle. And Dan highlighted that it's narrowing down the scope of who can develop to really the experts. Dream and Paul's have been developing multi-res for decades. We're still doing so, not in the REIT, but we're seeing our people have their fingers in that and their noses in it day to day, and we're seeing those challenges play out. What's interesting on the value add side is that some of the supply chain woes that started for us happening well before inflation. This is well into the beginning of last year. We started to experience that, for example, with appliances. Now we're seeing that start to swing back the other direction, where some of the supply chain problems with ground up construction are actually improving now on the value add side. So our appliances, for example, they went from needing about 30 days of lead time to about 90 days. And now we're starting to swing back down a little bit towards 60 days, which is enabling our value add program to accelerate and streamline. So that's an optimist or a positive side for what we're experiencing right now. One thing I just want to highlight is that people are not moving into homes. That is across our country. The housing prices have gone up 20% in the past 12 months, and the preceding 12 months before that was 16%. So that's roughly, rough order, Cro-Magnon math, 36% in the past 2 years. Rent is trailing that. So there is still a lot of organic rent growth before it even comes close to what has been happening in the housing. Right now, the percentage of residents that are leaving apartments and moving to homes is the lowest it's been in 5 years. We are seeing the fastest decline in U.S. housing affordability in the past couple decades. So it's a pretty bleak picture right now for people that would want to be moving into a new home. And that is going to be exacerbated in the near term by what we're seeing in the macroeconomic scheme with inflation and with interest rates. So we believe that the cyclical demand is going to continue to be strong, and the structural problems with supply are going to continue to inhibit it. And that matrix lends itself to, if you're in a pro-business, warm, less regulated place, whether you're in A, B, C, whatever, middle or upper, wherever, we believe there's a wide swath for continued exceptional demand in the for lease space, and we're very excited to be part of that.
Fantastic. So that kind of brings us to what should be the last broad question for the group. Earlier today in the industrial panel, we had a REIT say that some of their growth is going to come from selling its hard assets and buying stock in their peers because everyone's trading so far under the intrinsic value. Discounts to NAV on such a in-demand, undersupplied, inflation-protected asset class of multifamily, it's head-scratching. So what is everyone getting wrong? What's everybody missing? I'll start with Phil because it's always been a bane, but I think everybody here fights against the same tide.
Yeah, I mean, we probably didn't, well, it's not probably, we didn't see the uplift that a lot of people saw last year during the 2021 recovery. I think that goes a lot to one of your original questions that, I probably answered too briefly is, what are, Canadian investors' reaction to the Netherlands, or what are our investors' reactions to the Netherlands? So I think we always have a hurdle to get over just because it's so far away. What does it really mean? And then, regulation is always a dirty word. And again, I can, very much demonstrate, through our own empirical operation results that it isn't necessarily a dirty word. So, our stock has been underperforming for quite some time, significant discounts to NAV, where I think now it's all getting incremental pressure just because the world is horrible. Nobody understands what's going on from a macroeconomic perspective. Inflation's terrible. Walmart's earnings are down. Target's earnings are down. Everybody's a disaster. And then in Europe, of course, we have geopolitical events, which are much closer to home, which they really don't impact the Netherlands much at all. Except for the incremental immigrants and household formation. So there's just so much noise in the world. I think it's hard for us to directly, I think it's almost impossible for us to fight directly against our stock prices and our NAV discounts. I think one of the other guys mentioned, what do we have to do? We just have to keep on operating. Again, our operating results are as good as they ever have been. Even through COVID, we never dipped below 98% occupancy. We can't get much better than that. We never dipped below 99% collections. Our NOI margins have expanded 250 basis points, and we're already well above our peers at close to 80%. So we're just going to continue to block, tackle, do what we do well. We're going to continue to remind people about all of the supply-demand imbalances that it seems like everybody on this panel has for slightly different reasons, but ours are fundamentally structural in the entire country. And so again, that just gives us a very valuable resource that isn't being replenished at anything close to fast enough. So we have to be patient, as difficult as it is. We have to continue to demonstrate people that we give a great dividend yield. We are growing internally and or organically and externally. And we also, when trading in an NAV discount like we are now, we're a great value play. So people can get the trifecta of value, income, and growth if they do take the time and peel back the onion a little bit to understand some of the complexities of investing in a REIT whose assets are 100% across the pond.
Wonderful answer. I'll ask Sandy the same thing. I mean, across both ends of the capital stack, it's a little unique, but again, it should be that much easier to have this fantastic inflation protection. So, what's your kind of answer to that same question?
I mean, look, I always viewed us as a value play, if you will. I think, prior to the pandemic, we were in the midst of raising a significant amount of capital, literally the days before the pandemic, officially took place. That would have, been a major transformation for the company at the time. And unfortunately, the pandemic had a different idea. So that being said, we've been trading at a significant discount to NAV ever since. We continue, our view is, and in my view on the capital markets, is continue to do what you do, perform well for investors, deliver returns, and you will be rewarded in time. I mean, we're one of the few REITs out there in the Canadian REIT universe that has raised our dividend not once but twice. Our dividend is 100% return to capital, and we're invested in some of the best markets in the U.S. in both the Sun Belt and in the New York tri-state area. And to your point, we invest in all ends of the capital structure, so we're very nimble in allocating our capital, depending on what is the best place to generate an outsized return for our investors. And we will continue to do so and deliver on that promise. I mean, our REIT is unique in that it basically brings an amalgam, if you will, of our various businesses here, our mortgage business and our real estate business. And our mortgage business has traditionally traded at a significant premium to book value, given the size of the portfolio, as well as the fact there's never been a loan loss. And our real estate business as well has traded at or close to NAV. Again, given the areas that we're investing in, which are defensive asset classes on the commercial side, predominantly small bay industrial and grocery anchored retail, and as well as some Canadian multi-residential. So we will continue to stick to our knitting, deliver returns to shareholders. And, when opportunities arise, if the stock were to continue to drop at this point, we may take a view that we would reactivate our NCIB and buy back our stock. If that generates a greater risk-rated rate of return than what we are seeing at that particular time in the markets that we look to invest in. So we're very nimble in that approach. And, where shareholders are getting us wrong is quite simply, I don't think they just quite understand the business and how we operate, which is something that we're continuously working on.
Wonderful. And just we've only got a couple of seconds left. So Dan, the same sort of thing. You're in massively liquid markets, as is Scott. With great price discovery. What are your thoughts about that now?
Well, and Scott, if you'd like, you can go ahead and, or I'm happy to. He said a couple seconds, and if you know me, I'll take a couple years to answer that question.
I'll follow your lead, Dan.
Okay, so I mean, if there's always a place for an SIB or a buyback, that's a bucket. Sandy said it well. We're looking at buckets of returns to maximize our total unit holder return. There's always a place for that. But what we're living in right now has nothing to do with operations or our product. The environment that we're living in is a credit-induced, I'll say, pullback in the market. And I can't find how it makes sense to walk into that when you're in a very, very lucrative and growing sector of real estate, where investments have continued to pay off time over time, and not the last 3 years, the last 10 years, but for generations. And to shrink your company using leverage in a higher credit environment in order to buy back your own stock. Now, there certainly is a matrix where that decision makes sense. And we are getting closer to those numbers. I know at BSR and the rest of the sector. I mean, it's a return-based formula. But overall, my viewpoint is, I'm thinking about our meeting after this, and I see that Shaylin's going to join, but when you are owning and operating a business that is in high demand and that will continue to be in high demand as a moat, in our case, foreign multifamily. And I mentioned Shaylin Northwest's case. I mean, you're talking about a $10 billion portfolio of healthcare across Canada and the US, Brazil, UK, Australia. I mean, these business lines are going to be printing money for generations to come. And there's a time for short-term thinking, but now's not the time. This product that we are selling every day on the TSX and that we're leasing every day is highly in demand on the street, and it pays our shareholders very well in the medium and long term, and in fact, in some of the short-term cases, to continue to grow accretively from an AFFO and FFO per unit basis. And the NAV will do what the NAV does, right? But I think Phil hit it. I think Scott hit it. Sandy hit it. You keep your head down. You keep to your knitting. You keep to your disciplines, and you also keep that formula there for what a stock buyback looks like. If we can make a 70 yield on buying back stock, sure, that makes sense, right? We're not at that point where buying back stock makes our investors more money than continuing to do what we've been doing for at least my lifetime.
Perfect. And thank you so much, everyone. In a couple of minutes, we'll have the senior living healthcare panel, but I'd like to thank everybody on this foreign multifamily panel. It was a wonderful discussion.
Thank you.
Bye.
Thank you, Rob
Thanks,
and
Rob.
Fred, for having us.
Thank you, guys.
Thank you.
Thanks, guys.